Wall Street has given up on these 3 stocks, and that's a huge mistake. Hello, lovely YouTube family. Welcome back to our channel. In today's video, we're going to talk about the 3 stocks that Wall Street has given up on that could end up being a huge mistake. What are these stocks and why are they not Wall Street's favorites? Let's take a look. The neglected stocks. Imagine if your portfolio contained stocks that we're going to talk about today. This could be highly discouraging. However, you shouldn't worry because in the long run, such overlooked equities might be excellent additions to a portfolio as the market's focus will eventually shift back to high-quality companies. Phillip International NYSE PM, Enbridge NYSE ENB, and Markel NYSE MKL are 3 equities that haven't seen much appreciation in the last 5 years but could produce substantial returns in the next 5. But why exactly has Wall Street given up on them? Number 3. Markel. Markel is a specialty insurance firm that shines only when viewed over long periods. The company sells niche products and invests the proceeds in stocks and privately held non-insurance businesses that continue to function autonomously. Over the last 9 years, its combined ratio, the percentage of premiums paid out as claims, has averaged 96.6%. This consistent profitability fuels investments in shares in private companies. For the decade ending 2019, the stock investments provided market-beating returns, averaging 15.2% annually versus 9.4% for the S&P 500. Still in 2019, Markel Ventures, the company's private equity-like arm, generated $2.1 billion in sales and $92.9 million in net income, growing 12.6 times and 22 times, respectively, from 2010. It's clear that the investments are paying off for stockholders. The company's book value has risen steadily over the years from $352 per share in 2011 to $822 per share today. This represents a 9.9% compounded annual return. Despite this, the company is currently trading at its lowest book value multiple since 2012, at 1.2 times. The discount may be due to COVID-19. Markel was exposed to a wide range of events from wedding cancellations to Wimbledon and the Olympics, but the company's management was more cautious than many of its competitors in projecting losses early in the pandemic. Good businesses are rarely discounted by the market, and Markel is a high-quality insurer with a track record of profitable underwriting and profitable investment. Those who are willing to wait a decade to buy and hold a stock are likely to see higher gains. Number 2. Enbridge. Most of the energy equities in the world have had quite a difficult year. Enbridge was an exception. Due to the pandemic, global oil consumption has decreased to 2014 levels, while natural gas consumption in the United States is expected to fall by 2% in 2020. It's no surprise that the stock is down nearly 20% year to date. Thankfully, economic activity is beginning to pick up. The U.S. Energy Information Administration announced in November that worldwide oil consumption was up from the third quarter but remained down from November to the previous year. In addition, the organization forecasts a 3.1% increase in U.S. GDP in 2021. The rebound in Canada is predicted to reach 5.1%. Enbridge will gain from this action because it controls the largest kilometers of the crude oil pipeline in North America and ranks second in natural gas. The enterprise, which operates as an energy toll road, is designed to survive temporary economic downturns. Enbridge's clients are investment grade in 95% of cases, and management thinks that only 2% of cash flow is at risk due to market price fluctuations. That could explain why the corporation just announced its 26th annual dividend hike in a row, with the shares yielding 8.1% in 2021. The company's distributable cash flow for the 9 months ended September 30 was $7.23 billion, a modest rise from 2019. This is partly owing to the company's financial stability and a $300 million cost cut. The stability might be a welcome addition to investors' portfolios, especially given how out of favor energy companies are right now. Because Enbridge is a Canadian corporation, investors should be aware of how owning shares may influence their personal tax status. Number 1. Phillip International. Outside of the United States, Phillip International sells cigarettes as well as risk-reduced products including the IQOS tobacco warmer and e-vapor products, with non-combustible products accounting for 19% of revenues in 2019. The company is making headway towards its vision of a smoke-free future. Although smoking rates in the United States have decreased from 42.4% in 1965 to 13.7% in 2018, they remain high in other parts of the world, particularly among men. Even though the stock has dropped 6% in the last 5 years, the persistent prevalence of smoking around the world has enabled the company to slowly grow revenue at an average annual rate of 2.7% to $29.8 billion in 2019. Over the same period, earnings per share and dividends have increased by 1.1% and 3.4% respectively. The present yield on the stock is 5.8%, and investors should expect much more in the near future. Over the last 5 years, Phillip Morris International has paid out an average of 87% of free cash flow in dividends, indicating that there isn't much potential to increase the payout unless the business can decrease expenses or improve sales. With the S&P 500 yielding only 1.57%, a regular dividend near 6% may be enough to entice many investors to invest. Why Wall Street reacts to a company's performance. Several research analysts engaged by Wall Street businesses cover most mid to large-sized organizations. These analysts have in-depth knowledge of the firms they cover, and their research and insights are sought by institutional buy-side investors. Financial models of the firm analysts cover are developed as part of their research efforts, and these models are used to provide quarterly and annual sales and profits per share predictions for each company. The street estimate or street expectations is the average of analysts' quarterly revenue and earnings per share (EPS) projections for a certain company. When a company delivers its quarterly results, it is considered to have met street projections or expectations if its reported sales and EPS statistics match the street estimate. However, if the business beats or misses Wall Street forecasts, the stock price might swing dramatically. Street expectation. The street expectation is what security analysts expect the company to make in terms of earnings and revenues. These analysts depend on research to reach these conclusions. The street expectation is a frequently monitored metric that is widely known throughout a reporting season for most public corporations. The phrase comes from the idea that the top trading analysts are usually based on Wall Street in the United States and Bay Street and Canada. An earnings estimate or earnings expectations is another term used, another name to mean the same as consensus estimate, which is not used as much these days. Investors' reactions to a company that fails to meet Wall Street expectations are frequently unfavorable, resulting in a significant drop in the stock price. A corporation that outperforms expectations, on the other hand, can normally expect its stock price to rise. Currently, the three companies we've talked about are considered as not meeting the street's expectations. To achieve Wall Street expectations, a business must perform better than what the analysts predicted. This applies to both revenue and earnings per share. Should a company fail to achieve what its expectations were, then it's considered a missed target. The company's plan for future and general market trends influence the amount of price when the company doesn't meet the targets. In general, the greater the shock, the greater the market reaction. The negative reaction to negative surprises is usually more negative than the positive reaction to positive ones. This means that if a stock misses expectations by a large margin, it is more likely to lose a large proportion of its value than if it exceeds the forecast by a similar amount. Stocks that outperform expectations can skyrocket in price during a strong bull market. Equities that underperform expectations in a negative market frequently experience steep price drops, but stocks that outperform expectations in a bear market often see modest increases. The market's reactions to a miss on earnings might also be influenced by the company's forecast. A solid forecast can temper the negative reaction to an earnings shortfall, while a weak outlook can nullify the positive reaction to an earnings beat. Just because Wall Street has given up doesn't mean that you should, especially if you have already invested. You see, these companies are not performing poorly, they just don't meet the set standards. Do you agree with Wall Street? And that's all for today, folks. I hope you liked the video. If you did, make sure you hit that like button and subscribe to the channel so that you never miss out on any amazing videos from us.